Good afternoon and welcome to this Moneyweb webinar. I am Warren Thompson and I have the great pleasure today of sitting in and asking Paolo Senatore, the Chief Investment Officer from Ashburton Investments, a few questions around how they've been navigating the markets recently. But thank you very much for joining us, Paolo.
Thank you for having me.
Of course, every webinar, it's highly encouraged to be interactive, so we encourage our readers to either ask your questions through the webinar format, or alternatively, you can email me, warren@moneyweb.co.za, and pose the questions to Paolo. But I think we're going to get going. Paolo, obviously Ashburton, I think compared to its peers, is a fairly new business, creation of the First Rand stable again. Just explain to us, give us a little bit of color around your personal professional history with the group and how your role now takes care of various types of clients under the asset management arm that we now call Ashburton Investments.
Okay, it's probably quite interesting. If I go back, I joined the RMB group in 95 and within the asset management, portfolio management space, got involved in 96 or so. There was a company within the RMB stable called London and Dominion Trust, and that evolved into RMB Private Portfolio Management and eventually into Ashburton. Ashburton, the name being around in South Africa for about 3 years or so, the South African entity, but bear in mind Ashburton in Jersey been running for a good 30 years or so. So it has a long history in terms of asset management of the offshore portfolios. But what we did essentially is to combine all the money management activities, be it FNB securities, RMB Private Bank Portfolio Management, and the institutional asset management capacity of Ashburton, and combine it into under one investment process, and so that we deliver similar type of outcomes to all of our clients, no matter whether they're a private client or an institution for that matter.
So a couple of years ago, if you were an RMB client, sorry to interrupt you, and you had a stockbroking account which you guys ran for that client, you would now be a part of Ashburton Investments. You'd be a client of Ashburton Investments.
In terms of the investment process. So the investment process would be exported into the securities business, the portfolio management business, and the institutional business. It's important to note, though, that whilst Ashburton in South Africa is a fairly new name, 3-4 years old, the investment process has been consistent going back a good 15 years or so, because it was under the RMB Private Bank mold.
Just to get this right, so Ashburton, as it stands at the moment, is an asset management franchise that caters for the institutional market, and there we're talking about pension funds and any type of institutional investors, as well as private client investors would either want unit trust funds or segregated portfolios where you invest directly for them on the JSE.
That's correct, yes. Okay, so it would be one overlapping investment process delivering into those client pots, if you want to call it.
Now, there's quite a few wealth managers running around under the RMB Private Bank brand and the FNB Private Clients brand. How do you interact with those guys?
So they would, for example, if a client wants a segregated portfolio, they obviously would buy into the FNB securities operation or the Ashburton private clients, and they would be delivered a segregated portfolio. So we are partners in that respect. And of course, some of our funds, be it the balance fund or the equity fund, would be or would service those wealth managers and for their client needs, obviously.
So let's turn our attention then, and just a reminder to, if you have any questions, to email me at warren@moneyweb.co.za or use the forum on the online. Turning our attention just to understand your investment process, and this is quite important because it's quite distinctive. I think we're talking off air about the risk of investing with a star fund manager, an individual. Your process sounds a lot more collective than that. So just take us through how you go about viewing the world and then obviously making decisions around asset allocation as well as individual investments.
Okay, I think that's very important, because what we try to deliver to clients is not an individual risk, but our investment process risk with all its checks and balances. So if a portfolio manager or an investment analyst wants to include an idea into a portfolio construct, it gets checked against a number of other people. And so we have the sanity check around it, and that's the risk that we deliver to the client. It's a process risk as opposed to an individual risk. Obviously, individuals do become star managers in their own right, but we've chosen the route of an investment process that we hope to deliver. And it's a top-down investment process. Our motto really is managers that are value fund managers, for example. We box ourselves into quality and focused portfolios. Our equity portfolios, you won't find portfolios of 60-odd shares. You'll find equities of about 25 in that order. property counters of 3 or 4. And so the total combination, 27, 28 shares within our portfolios. And that's quite important, because what we do is we build a reference portfolio, which is a typical balanced portfolio, both offshore and locally. And then we replicate everything out of that portfolio. So, for example, once we create this balanced portfolio, obviously it has an equity block. That equity block is the exact same construct in our equity portfolio and is used in any other portfolios that we use. So our equity fund, unit trust, has the same equity holdings as the equity portion of our balanced fund, of our targeted return fund. And that's what the process delivers. It's a top-down process, macro first, sector allocation, and then within the sectors, stock picking. So what we've done is we've created fairly small teams that have the ability to make decisions on the asset allocation side. That would obviously allocate to equities, bonds, property, offshore. And then within that, equities, you'll go to industrials, commodities, financials, and then the financial team or industrials team or resource team would sit down and then say, well, how do we populate what we've been given? So, for example, if financials has been given 20%, how would they populate that with First Rand, Standard Bank, Sanlam, for example? They would make those decisions. But the point is, they are teams of 2 or 3 people with in-depth expertise in that area to make that specific call on how to populate that sector. So we don't expect one portfolio manager to have all asset allocation knowledge, all stock-specific knowledge, which is quite demanding. We actually rely on each other and the skills of each other to create this best investment view or this reference portfolio. And hopefully we have pockets of expertise that then can deliver this one whole balanced portfolio from which everything else comes out of. So it's quite interesting to note, if you have a balanced portfolio, for example, for a pension fund, in a segregated portion, that would be delivered as an outcome. Our balanced unit trust portfolio, through which a retail client invests, will get exactly the same output. And so it would be a similar outcome for both the pension fund and the private client, provided, of course, the mandate is the same.
Let's just unpack that a little bit, because I think there's a lot of people that would have been listening to that and just trying to understand it. So you sit together with your portfolio managers and your analysts. You're in charge of this process as the chief investment officer. You can potentially invest in quite a wide array of markets, because there's South Africa, you have a presence in the UK, and you can invest money in the US, and I imagine quite a few markets in Western Europe as well.
Yes, so we can go more than that. We can go to emerging markets as well. It's probably worth mentioning what we do is we have 3 arms, one in London, one in Jersey, and obviously the South African arm. We sit together in a global macro forum and we come to a conclusion as to the global outcomes. So be it US interest rates, US inflation, European inflation, so forth. So we have a consensus view. Once again, it's a team-driven approach, a consensus view of the macroeconomics that will be delivered to the globe. And then we split out into the offshore side, asset allocation first, same with local asset allocation. And then on the international side, obviously it goes to the asset allocation and then the portfolio construct. But that offshore portfolio, it's our global growth portfolio, very similar. A Reg 28 balanced portfolio is able to invest globally. So it will have positions in Japan, Europe, USA, for example, but it too will buy into some of our specialist funds. So you get a very attractive region like India, for example, economy growing 6-7%, looking relatively attractive from a growth perspective. So we're able to allocate to India too, for example.
Right.
And we would do that through one of our specialist funds, either directly or through one of our specialist funds. In this instance, we have a specialist fund, the India Equity Fund, so we're able to take an exposure to India, for example. We have other specialist funds like the Energy Fund or the Africa Fund, and we're able to utilize those funds in building a global portfolio that is not just Western world, but has exposure to some of the emerging market countries as well. And of course, at the moment, I'm sure you're aware, the emerging market is quite a robust story at the moment.
Let's just dwell on that macro view at the moment. I mean, obviously, the world that we live in has been characterized by super low interest rates in the developed markets. We've had massive amounts of quantitative easing, which is money creation in those developed markets. The US seems to look very healthy, as well as China, and you've just pointed out India. So where are you seeing, if we look at the global economy as a whole, where do you see big pockets of growth?
I think we have been positioned to some degree in Europe. Looks like it's a fairly robust recovery story. You know, the big fear, if you go back in Europe, was the inflation story. That seems to have been overcome. There's some inflation in the system. And the economy, if you look at the German economy, for example, quite robust, and valuations look relatively attractive. So that market has been interesting, and of course there are those regions like India which are growing very strong. It's also probably quite important from a South African side, the growth of the Chinese economy and its demand for commodities. So it's interesting on the commodity side, we don't really see a super cycle in commodities that will drive that commodity story to the highs and to the strength that we've seen in the past. What we did see, and we saw commodity run, is partly because we saw the supply side adapt and reach some balance, and the commodity prices had quite a nice rally. And more recently, they've come back, like iron ore, for example, has come back a bit. But the Chinese story becomes very important for the commodity play, and is it sustainable at these levels from commodity prices? The difficult part, of course, is reading the US market, and there was a post-Trump a very strong market. I mean, the US markets...
The Trump bounce, right?
Bounced very strong, obviously. I mean, we're talking of markets that probably over the last year or so, the MSCI, has hit a double-digit return, and to some degree that's partly the US has some responsibility for that. But in the short term, there's maybe some concern that growth might not be as strong as originally thought. And then, of course, you have interest rate hikes potentially, and we think potentially 2 hikes this year and 2 hikes next year.
Okay.
And at some point, that comes into slow economic growth as well. But for now, the world seems to be in a better shape economically speaking.
And that's something that's benefited us. I mean, we can speak at length about political developments in South Africa. But, I mean, if we look at the rand since what happened to Pravin Gordhan when he was fired, quite amazing that we haven't seen a stronger depreciation and more risk-off, what they call the risk-off trade in our own economy.
Well, remember, the global growth is in a better space. Emerging markets are in a better space. And, of course, the rand is a proxy for that emerging market story. It's a well-traded currency. It's a reliable currency to trade as well. So I think it plays off a little bit on that. And there's some dynamics in the South African market which play, if you look at current account deficits, starting to improve, and those play in its favor. And then, of course, you can't take away the carry trade. There is this real yield, which is quite attractive. Bear in mind, in South Africa, inflation would probably look to go down to as low as 4.8 and then pick up again to the 5.5 level again. But, you've got 10-year yields at about 8.7 in that order. It's not so easy to look where to go in this market because our forecast returns are quite similar for equities, cash and bonds, for example. So the question is, do you take on these risk assets when your forecast returns are quite the same? So cash at 1-year NCD just over 8%, a 10-year bond at let's say 8.7.
There's not much being offered
to take on the risk, yeah. So, it becomes quite difficult how you actually play it. And same with the rand. The rand strength can continue. I mean, who knows if it goes below 13, of course. It may well on some of the momentum stories that we've mentioned. Longer term, however, you would expect some depreciation because of the inflation differentials. But it's difficult also to know where the dollar's going. Will the dollar get weaker because potentially there's some concern about will Trump get policies through, will growth come through? And of course, on the other hand, you have rising interest rates, which should be attractive for the US dollar and potentially might lead to US dollar strength. So it's not just about working out the rand. Of course, you've got to work out the other side of the equation, what's going to happen with the dollar and, versus the euro, for example. I mean, it's quite feasible that the euro may strengthen because of the momentum that's being gained in the Eurozone with regards to growth. And currencies get attracted for either you've got a really good real interest rates or you've got a growth story. And those are two of the reasons, I guess, why currencies may strengthen or weaken. So you'll either go into a currency because there's a great growth story for that country or just because interest rates are so high they become, and the carry trade takes place. But in the South African context at the moment, it's quite difficult to, and you did mention the rand strength, it's been quite difficult for our market because our market is populated by companies which have a strong rand hedge bias to them. I know Naspers has done exceptionally well this year. I think we're up over like 30% return this year. But the rand hedge nature is big. It's British American Tobacco, it's Richemont, it's Steinhoff. You can just rattle out the rand hedges. So they have that headwind to overcome, of course. So from a South African market, it's quite interesting because the South African market is not really such a proxy for the South African market. I mean, the banks are, of course, and things like Mr. Price are, the retailers. But if you look into the South African market, when you look at the retailers and the banks, actually there's some pressure there, and pressure with regards to forecast earnings going forward because of the consumer is under pressure. But all I wanted to mention is that it's a strange market. If you take Naspers and Richemont together, that's 25% of the market index. So the South African index, the all-share index, is not really a proxy for South Africa because a large part of it is trading outside of South Africa.
I think that's probably a process that's separated over years as more and more companies in South Africa that are listed on the JSE have gone and invested overseas and have started to earn income from overseas. Just touching on that idea that Naspers and Richemont, as you pointed out, account for 25%, a quarter of the JSE's entire value. I mean, that is just staggering. any fund manager has to have a view on those two companies, because if the holding is smaller than that in your portfolio, you better pray you're right. And if it's larger and those two fall, well, then you're in big trouble. So tell us your views there on those two, Paolo.
Somewhere you have to say, is the index responsible?
Right. Because it's so concentrated in two companies.
Would that be wise investing? We're typically quite cautious when we go over and above a 10% weighting in a specific stock. So we look at it really in depth and ask the question if we've gone, because sometimes you get to those positions just simply because the price has rallied. Obviously, that's happened to Naspers. So when you get to 12%, 13%, you do ask yourself the question, is it prudent from a portfolio build perspective, construct perspective, to just pull it back to the 9-10% zone? It's quite difficult, obviously, to say if Naspers is 17% of the index, should I go overweight? Because that implies you need to go to 20 or something. That might not be such a prudent portfolio manmanagement.
And there's some rules that actually prevent that in balanced portfolios,
yes.
Right? You can't even hold a stock up to, I think, north of, is it 10%?
You can go over 10 if it's through growth, yes.
Okay.
So it becomes quite difficult to face that index when you've got this kind of dynamic, which is quite unique, I guess, to the South African market. Of course, you can, however, play it differently, and you might say, well, I'm not going to have 17% in an IT stock in South Africa in Naspers, but I can build it out through other avenues, maybe like an EOH, for example, which is exposed to some degree in that index. Or you might take it through your offshore portfolio,
right?
Through, you can have Amazon or Google or Visa. These are Microsoft, counters like that, of course. Those offer opportunities in an indirect way to try and get, for example, the IT exposure, not necessarily just through your South African construct, but through some of your offshore build as well.
Just coming back to the resources, just to round that out, you have a view on China, which sounds like it's quite positive. It's not going to drive a resource consumption like we saw in the last decade.
Yes.
But an economy that size now, it's the second biggest in the world. It's growing at a clip of about 6%, I think, according to official numbers, and it's expected to continue. How does that translate into a view on South African resource companies?
So we've taken the view, we've stayed out of the precious metals, the platinums, the golds. Very difficult for us to read. Those companies per se are not really profitable at current platinum levels, for example. We've taken the diversified, which are more exposed to the industrials, so the Billitons, the Anglos, for example, and we equal weight those counters, relatively speaking, to the index. And we're quite comfortable with that positioning. We don't think, as I say, there's a super cycle on the way. We do think, obviously, China, if you go back some time, has tried to restructure their economy more from an infrastructural spend into a consumer spend.
Right.
Partly because they overspent in the infrastructure space, but more recently they are pushing a little bit back into that infrastructure side to keep the growth momentum at around the 6% mark or so. So that should be supportive for resources, we think, over the next while, whilst we're not really comfortable to go significantly overweight that space. As a resource as a whole, we are slightly underweight, but that's because, as I mentioned, we don't have the golds and platinums in our portfolios.
So, and just from the Chinese perspective, it looks like we talk about this transition into services and more higher value added. I mean, we're seeing the Chinese really starting to compete in things like shipbuilding, arms manufacturing, high-tech electronics, those types of things. So that shift is definitely taking place. But every once in a while, when the growth doesn't quite come through, they revert to the old model of just building infrastructure to kind of increase the GDP growth. Is that fairly accurate assessment of a very big...
I think they have the ability to pull these levers as needed, but you cannot deny, China has obviously become a major global player, and it participates in manufacturing around the globe, in industries that you've mentioned. So they've obviously come a long way, and but it's interesting that they do have the ability and then they have the balance sheet, of course, to pull the levers to keep that growth momentum going. But of course, it's not realistic when you're such a large economy to expect that 6% can last forever. Eventually, it comes to 5 and 4%, just simply because of the size, of course. And so it's that much more difficult to grow off a growing base. And invariably that growth rate will come off. But it's still a strong story, of course. And certainly on the consumer side, it's grown significantly. And I mean, for a player like Naspers, that with Tencent, of course, that's a meaningful proposition for that business. It's a very strong, when you talk of a number of users, for example, on their platform WeChat, I mean, you don't talk of 10 or 20 million people, you talk of 900 million participants. I mean, these are big markets in their own right. I mean, this is massive stuff, massive numbers. I mean, people tend to forget how big, China is in terms of the population size. And of course, as they get driven more and more into consumerism, it does benefit players like financial services, players like Tencent, WeChat. So they're in a very good spot. And of course, Tencent's results came out and they were really above most expectations, of course.
Let's just unpack this Naspers, just to dwell on Naspers, because we talked about how Naspers has subsumed the South African market, where it accounts for 18% on its own of its market cap. Within Naspers as a business, Tencent has subsumed Naspers. As far as I understand it, when we think about how much money the DStv makes and some of the other businesses that they're involved in,
small, yes.
How much does this 10% account for Naspers' value?
Well, it's pretty much all of the NAV at the moment. So you get
all of the net asset value.
You get your DStv for nothing, essentially.
Okay, and the market cap?
I don't know it offhand, but it's quite interesting. You say 17% of the JSE, which is not sitting in South Africa, it's sitting in China.
A Chinese tech company, basically, accounts
dominating,
for 15, 16% of our entire market.
That's correct. Yeah, so that's the strange nature of our economy. But it goes back to, be it British American Tobacco, Richemont or Steinhoff or, any of these type of companies. I mean, South African companies have actually been quite successful at externalizing their businesses. By and large, been very successful. So Naspers in our portfolio is our largest holding. It sits at around 9% or so. So we too have a very significant holding in that counter. But that's because we're very comfortable with the outlook for that company and the earnings and growth story. But of course, we hold it back just from a portfolio construction perspective and the risk associated if something were to go wrong.
Okay. Just coming back to the view on the sector and asset allocation, I'm just keeping my eye on the time here. But where does fixed income fit in your multi-asset class portfolios at this stage?
So
and how do you get exposure to it? And how are you getting exposure to it?
Okay, so there's just back on the investment process, there's three channels. The one is the multi-asset, which decides how much goes into the various asset classes.
Shares,
and equities,
bonds,
and
cash, property.
The fixed income is a parallel, which then we say, for example, 14% will be allocated to fixed income. The fixed income investment process then populates that 14% with bonds. At the moment, in our balanced portfolios, we hold only government bonds at the moment. And we are slightly short duration, and we're underweight bonds. So that is the one side we're underweight in favor of cash, partly because I said earlier, on an NCD you can get just over 8%. On a bond for 10 years you can get 8.7. If it were to go over 9 again, we might lift our bond exposure, and certainly if it were to come to about 8.3 in that order, we might look to lighten again. So we're in a phase right now of a range within the bond market, either lightening or adding to, and it's in favor of cash. And then on the equity side, we're pretty much neutral, slightly underweight, but it's really marginal position underweight on the equity side. But even our forecast for equities this year is around 8 to 10%, and bonds is around 8%.
Returns you're talking about
yes,
now? Yeah, 8 to 10% from holding shares on the JSE, for instance?
As an equity return.
Right.
Cash is around 8, and then bonds around about just over 8 as well. So the problem is in the current market is our expected returns are so similar, it becomes very difficult to take a significant overweight bet in any of these positions. That's why I said we neutral our equities. We slightly underweight bonds in favor of cash, and we're neutral on our offshore positioning as well. But of course, if we see the rand strengthen, it goes below 12, maybe 12.50 or so, we may consider adding to that into that proposition. So when the rand was a lot higher, we actually took some funds back. So that's some of the transactions we've done, some of the offshore positioning back into South Africa, and we brought it back to neutral. So you can see our portfolio positioning at the moment is quite neutral across the board, except for that underweight bond, and that's because our forecast returns are quite similar. I mean, I do remember going back in time where your forecast equity return was twice your fixed income return.
Right.
And it's quite easy to go for a 70% equity weighting,
So what you're saying is the equity market's not really that attractive at the moment.
Well, if you got to drill down within the equity market, there are some attractive valuations. So we slightly overweight the banking side or the banking stocks. There you can get Ps of 9, around that order, dividend yields of about 5. If you go to APSA, we don't have APSA, but you can get a dividend yield of around 7%. So it's quite attractive from a valuation perspective. We just don't think in the next year that will unravel, because earnings per share growth will come through, single-digit type numbers, 6,
like
7%. Yes,
right?
Like we've seen. And maybe their story is a 2018 story. So growth this year we think will pull back to about 0.7 or so.
That's GDP growth for South Africa?
Yeah, which if we go back some time, we had that growth at over 1%.
But 0.7%, for a country that has population growth, I didn't check what the last population growth number was, but I'd imagine it's probably about 2.5%. We have these fundamental questions around how we employ more people, how we get the youth into the economy. What do you think the number's got to be?
Well, you probably need growth of 4 or 5%.
Which we haven't been near for quite a while.
Yeah.
And there's still what we call downside risks probably on that view. I mean, if you pencil in, if you had to give me odds on what would the chances be of a second downgrade, which would result in this mandatory selling by global bond investors, that would have a tremendously negative impact on that growth number, I'd imagine.
No, it would, of course. And then the cost of finance, even for the banking sector, which I mentioned, shows value would change as well.
Right.
So, that downgrade would be on your local bonds, of course, and that's probably a potential, year out or so. I think that'll take some time to materialize, and hopefully we can
turn the ship.
I think, of course, growth is our big problem. To be inclusive, you need growth. To get the youth in the economy, you need growth. And as I mentioned, growth this year only around 0.7, and then next year it'll go back into the low 1% or so. So for the next 2 or 3 years, you're not really seeing you're seeing a recovery, but not a massive recovery. And that's going to be a difficult environment for the retailers and the banking stocks. So while some of them show value, it's quite hard to unlock that value without the growth story behind it. So I think what we will see, and we have seen it in the past, is big divergence between sectors.
Okay,
so, in 2016, we saw a really strong resource sector and not such a strong financial sector, for example. So one has to be wary of that.
Just one last question on the process, and then we just round out the interview, because I see we're coming to an end there. And anyone who's got questions, please email me, warren@moneyweb.co.za. What happens if an analyst, with this top-down approach that you've described, where you look at the macro picture first, how economies are doing, then you make decisions around what are the expected returns from different asset classes like bonds and cash and property and equities or shares. What happens if one of your analysts goes out and goes and finds a very promising company, a small or mid-cap company, and they come back? How does that play into your investment process?
So that promising company, there must be a top-down supporting view on that. So that market segment's got to be attractive. And then by all means, he can motivate and populate that within the portfolio, for example. So, you might say there's a conducive environment for the banking sector, and he finds a specific bank, maybe it's a Capitec, for example, and he can motivate it, then certainly, by all means, we can put it in. But for a company to really come through, it does need the macros around it to be supportive of as well.
Okay, now I think that's quite a difficult one, because I think if you looked at, for instance, the book market, maybe 12 years ago, 15 years ago, whenever Jeff Bezos started getting going with Amazon and decided to start selling books online, there was a disruptive business there, and I having scratched around looking at companies myself for a while, trying to pick up how well a company can disrupt an industry is incredibly difficult.
Yeah, it's very difficult.
So how do you factor in? We mentioned Capitec into an industry that looks pretty set and market is going to generate the same returns as the rest of the market. So if you look at banking and you say banking banking, the big four, were going to give us a 12% return every year. And that was similar to what the JSE was going to give with other companies. Yeah. How do you try and get your head around a disruptor like a Capitec?
No, within that sector, you'd look for the disruptors. I mean, I guess that's
so
why...
you actively look for disruption?
That's why I guess we have Naspers, for example. I mean, that would be Tencent was a disruptor in its market, you could argue. So you're certainly looking for those companies within a sector that can change the game. I mean, it's our research on stocks. That's why I say we don't leave it up to one individual to cover the whole market. We have these small pockets of in-depth research and knowledge, and we do expect our financials, industrials, resources teams to have that knowledge to look in-depth for those new disruptors, because those ultimately will be the winners, provided they meet our quality criteria. So they've got the right governance around them, they've got a history of earnings growth, we've rated. So there's qualitative and quantitative measurements. We have a positive view on management, for example. So there are certain measurements, quality screen that we go through. They have to meet our quality screen, because that is what we sell, a quality bias. Yeah.
Right, so there we have it. I think, Paolo, we're going to have to leave it there. Thanks very much for your time. I'll take away that we need to look for disruption. The quality disruptors, I think, for some of the stocks that really change portfolios and create wealth. But thank you very much for your time. It's been very interesting listening to your views.
Thank you very much.
That was Paolo Senatore, the Chief Investment Officer of Ashburton Investments. And that brings to an end our webinar. So if you would like to catch the webinar in full, it will be up on the Moneyweb platform tomorrow.